If you're coming to us from our first video in our cash secured puts series, you should have a pretty good idea of how these work and where they derive their value from. And as we alluded to at the end of that video, not all stocks are the same with this strategy. So the main question that remains is, how do you pick a stock? Welcome to part 2 of our cash secured puts series, where we talk about just that, picking the stock. Welcome to the Hourglass Trader, where as time passes, we make money. Alright, so let's first look at some basic principles that we're going to want to consider when we look at selling cash secured puts. The first thing is that we want to pick a stock that we're okay with owning long term. Because if the stock goes up, we'll collect max profit, that's great. But what happens if the stock goes down? Sometimes we're able to roll for a profit to a lower strike, but in worst case scenario situations, we get assigned the stock, albeit at a favorable basis. So we want to make sure when we enter a trade that we're okay with owning that stock at that adjusted basis. Because that way, if things hit the fan with your trade, at least you'll have shares at a basis you're comfortable with. The next point is that we want to pay attention to things like IV, which is implied volatility, IV rank, and return on risk. Not all stocks are the same, obviously, and looking at these statistics regarding a stock is going to help you differentiate what stocks are better than others for the strategy of selling cash secured puts, because these three things, or the first two rather, are things that make up option premium, and then the third is one way to evaluate how good that option premium is based on how much money you're investing and putting up for collateral on these cash secured puts. So it's really important to look at these three things on the stock that you pick to make sure that you're getting good value and you wouldn't just be better off buying and holding the stock long term. The third thing is that we want to avoid stocks in risky industries or with bankruptcy issues. And this kind of goes hand in hand with the second point that we have up here, because a lot of the time you'll find that if a stock has high IV and a high IV rank, which equates to inflated premium on the options, it's because it's in a risky industry or might be approaching bankruptcy. Airlines are something recently that have been a great example of this, where selling puts on those offers a great return, but you've got to really be careful, because if a company goes bankrupt, all the shareholders could potentially be wiped out. And really the biggest risk that you run here, and the risk that you run with any stock ownership period, is that the shares are wiped out or go to zero. So we want to avoid something where that's even something within the realm of possibility. So avoid those stocks that are in risky industries or might be approaching bankruptcy. And then the fourth and final thing is we want to take areas of support into consideration. And this mostly has to do when we set our strike price that we sell our cash secured put at, but it's always great to do a little bit of base level technical analysis on the chart and to figure out where you think the stock might bounce off of, what you think is a strong area of support, and maybe look at some other measures of technical analysis to decide, okay, this is a strike price that I'm comfortable selling my put at. I don't think it's going to go below that. But then again, we circle back to point 1 on here. If it does go below that, we're okay owning the stock long term at that basis. So just to go back through these points a little bit, we're going to hit on all 4 of these throughout this video. The first one, we're going to talk a little bit more about picking a stock you're okay with owning long term. We like to look at our watch list that we typically have up on the left side of the trading screen when we're up on Think and Swim, because that's stocks that we're familiar with. We are familiar with their price action, and we're familiar with valuation and trends within the stock. So if something happens, we know where a stock should be versus our expectation, and we have probably a number in the back of our head that we're okay with owning the stock at. If you see something come across the wire about a stock that's a hype stock, something's going crazy, so premiums are inflated, that might not be something you're okay with. Now, granted, there are some situations where that's okay, because the risk that you get and the return that you generate from selling puts makes it worth it in the end. But we typically like to stay with stocks that we're comfortable with, and we like to perform a little bit of financial analysis, which we'll hit on in another future video. But that's just kind of one of the ways that we get comfortable with these stocks that we're selling puts on. We want to be really comfortable with the company. We want to be really comfortable with the business model. And we want to be really comfortable with the fact that long term, if we were to be assigned these shares, it's a good investment. And down to that second point, we want to pay attention to IV rank, and return on risk. So let's jump into Think or Swim real quick and take a look at these. All right, so here we are. We're going to use Apple as an example. We're back in Think or Swim right now. This is probably when you go to the trade tab, what you're used to seeing. You've got your calls, you've got your puts here, you've got your watch list out left. And we're going to use, since it's Wednesday after market, we're going to use next Friday, October 16th's options for this example, since that's probably going to be more representative of the actual premium you'll receive if you were to do something like this on a week-to-week basis. So going back to IV and IV rank, where are you going to see those? It's great that we've got the calls, the puts here, our standard view, but where do we actually go to get the detail about the stock that we're looking at? So if you minimize this row and go to today's option statistics, you'll see both the implied volatility, which is 49%, and the current IV percentile, which is 37%. Going back to our example, it's a little bit low, but Apple's a relatively safe stock, so we really aren't too concerned about that. This is one where, since it's below 50%, might be a better buy and hold as it stands right now. But there is one thing you have to remember, is that sometimes in the past calendar year, there's a super big volatility event. In our case here, it is coronavirus causing a ridiculous dip and then subsequent spike on the recovery. So that's obviously going to introduce a lot more volatility. So when you look at IV rank, anytime within the calendar year after kind of the COVID spike that we had last March and April, we really are probably going to see a lower number here than we would any other years when we invest. So you have to take that into consideration as well. So IV ranks 37%, IV is 49.81%, which is all right. It's a bigger stock. And when we look at this, the other thing we had in that bullet point on the slides that we were looking at is going to be return on risk. So we know that when we sell puts cash secured, we're putting up a certain amount of collateral. So we want an easy way to see what the premium here gives us as far as returns go for the amount of collateral that we're putting up. So what you'll want to do is go down to option theoreticals and Greeks and switch over to return on risk. So this shows you in percentage form the amount of return you're getting based on the amount of capital you put up to cash secure these puts that you sell. Obviously, the further into the money you go, the better your return is going to be, but you can still go decently at the money and get a nice return on the stock that you are selling the put on. So we can see right here 1.63, 1.79, it comes up into the twos. If you want to get risky, you could put it as close to the money as you would like. But there's something important to keep in mind, and we've got this right over here, and it's the fact that a small weekly return compounds into a big amount. Even just a 2% weekly return compounds into a 180% annualized return. So if we've got something like Apple where we can get a 1.96% return on something that's just under 2% out the money, that's pretty good value. Either we're going to have Apple drop and we'll get Apple shares at a basis of 111, which is a great value since it's at 115 right now, or we'll collect the max profit, which will give us a 1.96 return, meaning that 1.96 return is 174% annualized. Now we know we're not always going to get that, and if you are going into investing expecting a 174% annualized return, you've come to the wrong place, and if you're seeking that, you're probably going to have an investing strategy that is a loser in the long term. And what we can see right here, another interesting thing, is that you could look at actually the probability that the strike prices will be in the money. So for the 113s that we were looking at, there's a 40% chance that these are going to finish in the money. So 60% of the time, you're going to cash in on that max profit of 1.96%, that return, and get those returns, which annualized equal about 170%. So that's one of the great parts about selling cash secured puts, is the fact that you could collect these small gains time over time over time. And even if something goes bad and Apple price really drops on you, worst case scenario, you're stuck with shares of a strong company. But let's compare this Apple to a stock. As we can see right here, let's flip it back real quick to return on risk, where you've got about 1.41 to 4.82 in the range of visible strikes. Let's compare it to something that we used from the last video, AT&T. So if we look here, there is a huge difference in the amount of return that you're getting on the capital that you put up to sell these puts. Now, why is that? If we look at AT&T over the past, let's see from right here, this is about from March, it's traded between $32 and $27. It's about a $5 range. If we look at Apple in a similar time frame, let's see if we could find March again really quick. It's traded between $53 and $137, and that is what creates the volatility that juices up the option premium and gives us good premium when we sell these puts. So headed back to AT&T, when we look at this, we look at the return on the amount of capital that we risk. AT&T really is not a good option for this strategy, and if you are a fan of the stock, you're just better off probably buying and holding for the long term, especially since AT&T is a steady stock that pays dividends. Apple, on the other hand, I could see going either way. I personally hold it in my buy and sell portfolio, but I also think due to the amount of return you can get per week on puts that are slightly out of the money, it's also a great option for selling puts. So we know Apple's a strong stock, but let's take a look at something a little riskier. Let's look at something a little more volatile like a Tesla. All right, so we've got Tesla here, and as you can see, these returns that you're getting around the money are a lot bigger than Apple's. We're getting about 4.10% at the money for Tesla, whereas we're getting about 2.77 for Apple. And the great thing about this is it only shows you 14 visible strikes, but you could back it up, and we're obviously not going to be selling 50 puts, but you can get down to about $400, which is pretty comfortably out of the money, and still get a 1.48% on that put that you sell. And again, similar like we explained with Apple, if the price of Tesla drops, you just get the stock at a discount of about $30, which is pretty solid from the current price. Now, obviously, there's trade-offs, and if you're a believer in Tesla, you might think that the amount of risk that selling puts introduces is far worth the amount of return that you're getting. And to be honest, that's just perfectly up to you. I think a great way to figure out if a trade is one that's worth making is to kind of talk about a trade in plain English and go back to that idea of adjusted basis and say, okay, if things really did go south for me, would I be okay with owning this share at this price? And at the end of the day, if that's something you're comfortable with, I think it's a great move for you to make. So we're actually going to cut this video off right about here. We try our best not to turn these things into full-length movies. We try to make them 10 to 12-minute digestible bites for you guys, because we know for a lot of investors, this is relatively new information, so it's a lot to take in. So keeping the videos on the shorter side instead of 20, 30, or 40 minutes long makes it a lot easier to comprehend. You can go back, rewatch it once or twice to make sure you've got all the material down before moving to the next one. So we're going to address bullet points 3 and 4 in our next video, which I guess we'll call part 2.5 of our cash secured put series. So until then, this has been the Hourglass Trader, where as time passes, we make money.